Exploring the role of interest rates in finance. Interest rates serve as the cornerstone of modern finance, representing either the cost of borrowing money or the returns on saving it. These rates are shaped by a myriad of factors, including central bank policies, the state of the economy, and the general demand for credit in the market. They are integral in influencing both individual financial choices and the broader economic landscape. The influence of interest rates on loans. In the realm of loans, whether it's for vehicles, homes, or personal borrowing, interest rates play a pivotal role. For example, in vehicle and mortgage loans, a lower interest rate directly translates to a more affordable cost of borrowing. This can significantly encourage consumers to take on loans, boosting spending in these sectors. Particularly in mortgages, which typically involve substantial amounts and long-term commitments, a slight variation in the interest rate can have a considerable impact on the total cost of the loan. Similarly, the fluctuations in interest rates are acutely felt in credit cards and personal loans. Lower rates can ease the burden of debt, while higher rates can dramatically increase the cost of carrying a balance. The impact on savings and investments. Conversely, savings accounts and investment products like CDs are also affected by interest rates. When rates are high, these savings instruments become more appealing due to better returns. On the other hand, low interest rates can reduce the attractiveness of saving, as the returns are less rewarding. A detailed mortgage example. Let's consider a specific example to illustrate the impact of interest rates. Imagine a 30-year mortgage for a house priced at $300,000. We will compare the scenarios at 2% and 8% interest rates. Let's look at the details of a $300,000 mortgage at 2% interest rate. The monthly payment for this mortgage comes to approximately $1,108. Over the 30-year term, the total interest paid amounts to about $99,189. Now let's take a look at the details of a $300,000 mortgage with an 8% interest rate. The monthly payment escalates to around $2,201. The total interest paid over the life of the loan soars to approximately $492,465. This comparison starkly highlights the profound impact of interest rates on long-term financial commitments. While the monthly payments nearly double with the higher interest rate, the total interest paid over the course of the loan is almost 5 times greater. Such a scenario underscores the importance of interest rates in the overall cost of borrowing. Wider economic considerations. Beyond individual financial decisions, interest rates are instrumental in regulating economic growth and inflation. Central banks manipulate these rates to either stimulate the economy by encouraging borrowing and spending or to control inflation and excessive economic heat by increasing rates. The choice between fixed and variable rates in loans adds another dimension to this discussion. Fixed-rate loans offer predictability in repayments, unaffected by market changes, whereas variable-rate loans fluctuate with market conditions, introducing a degree of uncertainty in repayment amounts. In conclusion, interest rates are a critical aspect of finance, deeply interwoven with personal financial decisions and the overall economic climate. They determine the cost of borrowing, influence savings returns, and reflect economic health and lending risk. A thorough understanding of how interest rates work is essential for informed financial planning and decision-making. Whether it's taking a mortgage, using a credit card, or saving money, an awareness of interest rates and their implications can significantly impact one's financial well-being and future planning. Consider subscribing for more finance videos.